Hello traders, and welcome to my video on the double top candlestick pattern. So with this particular pattern, what you are looking for is two places where price has reached a resistance level, ideally following on from an uptrend. So for example, here we have an uptrend. Okay. And then we're going to mark off on the charts resistance, which is around here. Okay, what we are looking for is this resistance level to be hit at least 2 times, hence the name the double top. 1, 2. It doesn't necessarily, you don't necessarily need price to hit the level exactly, as long as it comes close enough, as you can see here. So this resistance level held up nicely there. Price didn't quite reach it and started to turn around, which shows that this is perhaps a strong resistance level, especially following on from the uptrend. So we have our double top candlestick pattern, double because there's 2 tops, 1 and 2, following on from the uptrend, and this is a reversal signal. So what we're going to do is look to take a reversal trade in the opposite direction. So how to time the entry? What you need to do with the double top candlestick pattern is to also mark the neckline, which is the level of support within the double top. So we would mark that probably around here somewhere. Okay, and what we're looking for, you can either mark it using the candle bodies or the candle wicks. And what we're looking for is price to break below this level here, break below the neckline of the double top candlestick pattern, and that will give us our entry based on this particular candlestick pattern. As you can see, there's a massive bear bar, which suggests either some news was released at this time, or loads of traders were watching this particular double top candlestick pattern setup, perhaps a combination of both. Either way, you can see how that would have been a solid entry. Perhaps if we do this trend line as well, it was tested 1, 2, 3 times, and then price did break through here, which would have been further indication to confirm this sell trade. Also, you can see price try to come back up. Some market indecision here. We have a spinning top candlestick pattern. It's like an inverted hammer there, all suggesting perhaps the bears are about to gain control of the market, as they did. This trend line that was acting as support then became resistance around here. So that coinciding with our double top candlestick pattern, a breakout of this support level, all strong indications for downwards momentum. As you can see, if we zoom out, price did fall significantly. I mean, if we would have entered on this breakout here, it's almost 1,000 pips on that trade. And this is the 1 hour euro, 1 hour dollar yen chart. I mean, 1,000 pips in the space of just over a week is fantastic. I'd much rather look for setups such as this on the higher chart timeframes than be stressed trying to trade all day on the 5-minute, even the 15-minute charts. I just find that the 1 hour, 4 hour and daily charts tend to have more reliable signals. Also means less time chart watching. Some people think that because you're trading on the higher time frames, you have to have a wider stop loss. It's not the case, as we can see from this trade. We could have put the stop loss above this resistance level here. It would have only been around 30 odd pips, which is reasonable for the 1 hour chart time frame, especially when you consider this trade went 1,000 pips. Huge risk to reward ratio opportunity. Well, that doesn't mean that you would be picking the perfect time to exit. I mean, many traders may have got carried away when they saw this bar and perhaps exited around here somewhere or during the pullback here. What you could have done instead is to maybe exit some of the position and allow the rest to run whilst moving your stop loss from up here to above this new level of resistance and allow the trade to play out. And after this next big drop down here, you could have then moved your stop loss further above this level of resistance. And what this does is just allows you to lock in profit whilst trying to maximize each move without exiting prematurely. You can also close part of the position, perhaps around here, take some off the table, half, and allow the rest to run. It just depends on your own money management. What you don't want to do is exit too early, especially on a big move like this. That being said, if you did, there would have been other opportunities to get in on this particular move. You can see here, if we mark this level of support, it held up well, but then when there was a breakout over here, you still could have caught some nice pips going down there. In fact, if we look closely, we can say that this is another double top candlestick pattern. 1, 2, neckline here, and enter on the breakout. Some may argue this is a support level and you could have entered up here, especially with the price action suggesting we're going to see downwards momentum continue. Others may have wanted to enter based on this resistance level holding up and enter here. Either way, ample opportunities to capture some action on this downwards move. What I wouldn't want to do is look for buy trades personally. It's clear that we're in a downtrend here, as the price action is showing you. Can of course use technical indicators if you wish for your entries. Let's just take, say, the stochastic oscillator as an example. Basically, for sell trades with the stochastic oscillator, you're going to look for price to be in this overbought zone here, above 80. For the main line to cross below the signal line suggests we're in the market is going downwards in an overbought zone. In and or around an overbought zone can be potential entry opportunities. So if we go back to our original entry, there was a strong, let me just get rid of these lines to confuse you. If we go back to the original entry up here, where was it? It was on the breakout of the neckline there, but the stochastic actually confirmed prior to that the market was overbought here. We were heading downwards and you could have looked to have entered there or just used it for additional confirmation of the trade here. Good thing about the stochastics is it's easy to understand, and you can find crossovers, potential entries all the way down the trend. It's good to use always keep an eye on resistance and support to confirm entries. If, for example, you're too far away from a resistance or support level, you might not want to take the trade based on the stochastics, but just when you combine it with support, resistance, price action, candlestick patterns, so on and so forth, you can catch some good moves. So yeah, that is the double top candlestick pattern in a nutshell. There's thousands of different ways you can trade with it. I wouldn't personally just take it as is, although you can. I tend to like to confirm with price action, candlestick patterns, technical indicators, and of course always have good money management and sensible risk to reward ratio. This can be a pattern. You can find this pattern on all traded instruments, all chart timeframes, but as I said, I find the higher chart timeframes to be more reliable, also means less time spent watching charts. Okay, thank you for watching. Hopefully you found this useful. Please like and subscribe for more.